speaking of our next guest, let's do that. And he does warn that the wild swings that we are seeing in some of these types of stocks may be signaling a cruel summer. Yeah, I see what we did there with the whole ape. Anyway, for the broader market, Julian Emanuel is BTIG's chief equity and derivative strategist, also a fan of the movie Karate Kid, which that song was featured. Julian, talk to us about your concern. Can you connect the dots between, 10 or 15 stocks and the macro market?
You actually can. But first thing I want to say, it's great to see the three of you back on set together, obviously referencing classic rock, and I'm looking forward to playing sports trivia with you all when it's time to take guests again. You, in fact, actually can connect the dots here. If you go back to January, we saw massive levels of speculation. Obviously, the stock that is the current superstar of this meme stocks right now was not the same one back in January. We all know what it was. But what you saw was just incredible froth in the options market, option volatilities of 1,000%. In this case, going back to the end of last week, option volatilities closer to 1,500%, which really says something in a market that there's been no other clear leadership for the last 2 months, a market where we still believe there is some concern with inflation that the Fed is not properly addressing, and frankly, looking at the number of bears on the latest sentiment survey, which hasn't been this low since right before Volmageddon in January of 2018. And we think if the music stops in these meme stocks, it could, like February and March, cause more volatility in the broader market.
Well, so it all comes down to the Fed and interest rates. I think that's what you're saying, Julian. So we're kind of starting to be hit over the head by Janet Yellen, Lael Brainerd, Bullard, others. I mean, they're kind of starting to say, guess what? Rates are going to go rise. They're going to go up. And Janet Yellen said today, that's not a bad thing. When rates go up, to quote the movie Margin Call, does the music stop or just slow down?
On balance, it's not a bad thing, but we really have to manage this very precisely. In a lot of ways, if you look at the last couple months, and we're almost glad to see the dialogue turning here, Chair Powell has been very, very, sort of shrugging off the fact that you have these very, very high readings and the fact that the economic data leads you to not be able to truly forecast whether inflation is transitory or is becoming more embedded. So what we would say is in an economy that's growing 6, 7, or 8% this year and looks set to grow at 3 to 4% next year, it's the right time to start pulling back from monetary accommodation. It's the right way before we make the mistake of letting inflation get too embedded. And if we move in that direction, the market could have a knee-jerk sell-off, which ultimately to us is a buying opportunity.
Hey, Julian, or actually, let me call you Cobra Kai. So, we have a case here where you're actually, though, bullish financials, bullish energy. Is that even in the context of a world where this inflation dynamic in the Fed and rates, or can we ride through this? Because there's fundamental arguments about energy. I certainly believe that the entire sector is different than it was 5 years ago in terms of how the companies are investing and how they're actually operating for shareholders, not necessarily for growth at all costs.
No question, Tim. It's a different environment. And you could argue that part of the thesis is to buy time in terms of managing the hydrocarbon business to diversify into other lines of more sustainable business, that makes sense with regard to an electric future. But for us, the fact is that this is a hydrocarbon economy for the next 5, call it 10 years, maybe longer, in an environment where there's been massive underinvestment here. And if you look at it in the S&P 500, these stocks, energy, represent 3% of the weight to the S&P 500 versus a longer-term average, which granted may not make as much sense, but that number is more like 9%. So could energy go from 3% to 4% or to 6% with the tape staying roughly at 4,200 on the S&P 500? Absolutely. You do those numbers. That's a gain in energy of anywhere from 33 to 100%. We think it's entirely possible.
Wow. And by the way, cheap tease, I'm going to be at an in-person oil and gas conference in Houston in a couple of days. So Yeah, with these companies that are soaring, by the way. Julian Emanuel, welcome back anytime. As always, thank you very much. All right, I want to expand this conversation. And Karen, I don't know if you can see output where you are, but I want to throw something up because in 1999, I was standing below where we are now and looking at, talking about Commerce One and ICGE and CMGI and Pets.com, and I got a picture, and there's like $2.75 when we had fractions trades. I want to bring up this cover. And Serge Millman, if you're watching, I hope I made your life better the other day, because I know you're this guy he was doing something with his daughter and everybody starts tweeting at him. That is April of 1998. And the cover of the Forbes, if you're on the radio, it says a bunch of kids are tormenting Wall Street about the rise of day traders. Now they're going to take on the big shops. And Karen, we all remember that period. And here's the thing. It sounds like Julian's kind of connecting these dots, but I will say this. When that cover came out, it was only another 2 years, 2 long years before things really rolled over. History may not always be the same, but it does tend to rhyme. Do you see any connection to the late 90s?
Definitely. I see a connection to the late 90s, right? We would have metrics, other metrics at the time, eyeballs, how many eyeballs a site had, and I never really knew if you had 1 eyeball or 2 eyeballs per person. But it didn't even translate to any kind of revenue or anything. So, I mean, and there was just euphoria and definitely a giant FOMO. But I feel like markets move so much more quickly now. So what was a 2-year or more bubble in its making then, I think could happen a lot faster now. You could make a case that some of the meme stocks will have value one day, and they'll survive and they'll have remade themselves. That could happen, but I can't get on board. I can't all of a sudden jump on a bandwagon that I don't understand how the valuation works. If you're an option trader, okay, I get it. But
yeah, just very quickly,
it's
Jeff,
the same. It's the same. I didn't do it then.
Yeah, comment on that, Jeff. Are you worried like Julian is?
You know, I'm not longer term. I mean, I think there's evidence now that the market is deteriorating some just from an internals perspective. If you look at the number of stocks trading above the 50-day, that has started to move lower. So I think there is evidence of some weakness, but I think overall the bull market is still intact. But I do agree with the point that you can see the index actually trade flat because you have a high percentage of market cap that's negatively correlated to rates. And I do think rates drift higher. So you want to be in the energies and the financials of the world, I think, going forward here.
Shepard Smith here. Thanks for watching CNBC on YouTube.